Over the last few years, the housing market has been making people's heads spin. It feels like we went from a real estate frenzy to a freeze. Everyone went from buying homes because of FOMO, fear of missing out, to not buying homes because of FOBAT, fear of buying at the top of the market. Now, I personally don't support decision making on the basis of FOMO or FOBAT because they're both motivated by the same thing, fear. In this video, I want to take fear out of the equation and arm you with facts about the current supply, demand, and interest rates. By the end, you'll gain an understanding of the Orlando metro market conditions and will strip away the emotional, one-size-fits-all approach to real estate decision making. I'm Lyra Martin, a Central Florida realtor with a medical laboratory background. I hung up my lab coat, but not my love of analysis and critical thinking. My channel is about providing data and thought-provoking information. The goal is to empower you with knowledge about the market. Unlike many parts of the US, Central Florida is an area that people are moving to, not away from. And unlike other areas, this migration pattern isn't some trend that ballooned during the COVID pandemic and is ending abruptly thereafter. Since 1950, we've been welcoming an average of 1,000 new residents each week. Over the next 11 years, that number is expected to increase to 1,500 new residents per week. And contrary to the stereotype, these new residents aren't only retirees and hospitality workers, although both of those groups are awesome. Aside from being the theme park capital of the world, Orlando's job market's extremely diverse. Defense, simulation, healthcare, aerospace. We have the largest university in the United States, semiconductor manufacturing, autonomous vehicle technology, startups galore. The point is that the population and economic growth that drives the housing market here is diversified and stable, not a trend. No offense, Boise. We can't talk about demand and not address supply. Unfortunately, the recent news reports touting dramatic increased year-over-year inventory are short-sighted to the point of being irrelevant and misleading. You need context. You see, in Orlando, we were sounding the alarms of a housing shortage pre-pandemic. In January of 2020, we had an available inventory of 7,030 homes. Remember that number. This was a record low, a deficit of 6,595 homes. So where are we now and where are we headed? Well, currently active inventory is up approximately 80% year over year, which does make it seem like the market must be saturated. That's not the case. You see, in a balanced market, meaning neither a buyer's market nor a seller's market, you should have around 6 months of inventory. How many months of inventory do we have? 2.1. Remember when 7,030 homes was a record shortage? We've added an average of 61,000 new residents each year since then, and currently have an inventory of just 6,884 homes. There have been some price drops and incentives recently, particularly in new construction. And this is giving some folks the impression that there's a big downturn coming and they should wait longer to get the real deals. Here's why this is erroneous thinking. The new construction that is for sale today has been 2 years in the making. Think of new construction as a giant lumbering machine with tons of moving parts. There's research for economic viability, land acquisitions, zoning, permitting, marketing, construction. So during the COVID-led housing boom, builders ramped up their operations to try to meet the increased demand. And unfortunately, because of all of their moving parts and the shortages of supplies and labor, they couldn't do it fast enough. Then, in 2022, the Fed begins aggressively increasing interest rates, but by now, the machine is on at full throttle. Builders, for the most part, are publicly traded companies. They can't just have their assets lying dormant in the form of unsold homes. So you have these communities right now with batches of inventory coming down the conveyor belt, and they have to figure out what to do with it. Thus, price drops and incentives on their quick move-in homes. But don't stop there and deduce that this rate of inventory production is going to remain the same. Just because the machine's conveyor belt took 2 years to get here does not mean it's going to take 2 years to turn down. Remember, builders are publicly traded companies. They have to hit their goals and turn a profit. It's far more prudent for them to scale back their operations, tightening up the supply, than it is to continue to pump out homes at a discount, taking losses. And this transition is already underway. Builders have been quietly resizing their workforce, halting land acquisitions, and slowing the pace of construction. Okay, enough about builders. What about the other source of supply in the market, right? What about the resale homes? Why aren't we seeing more resales come to the market? Mortgage interest rates. You see, if you're a homeowner right now, odds are that you have an incredibly low interest rate on your home. You either bought during the historic low interest rates of the pandemic, or you stayed in place and refinanced during that time. So let's say that you have a $400,000 home loan that you financed or refied at 3.5%. Your monthly payment would be around $1,400 per month. That same $400,000 mortgage at a 7% interest rate is $700 a month higher. That is why sales appear to be slumping right now. It's not that people aren't still moving here and buying homes, they totally are. It's that the current homeowners are sitting tight rather than upsizing, downsizing, or shifting as they normally would. So let's address interest rates then. I'm often asked where I think interest rates are headed and when they will go down. Be skeptical of anybody who says they know the answer to that question. Even the predictions among leading economists vary, so all we can do is examine what is known. During the pandemic, the Federal Reserve took emergency actions to bring down already low interest rates to record lows in an effort to stimulate the economy. It was stimulating. Now, in response to surging inflation, the Fed has begun aggressively increasing interest rates. Well, to be clear, the Fed doesn't exert direct control on mortgage interest rates. It's more like a ripple effect. The Fed makes it more expensive for banks to borrow money. So then when you go to the bank for a home loan, the Fed passes that increased cost on to you in the form of a higher mortgage interest rate. Federal officials have indicated that they'll consider pausing rate hikes after clear and compelling evidence that inflation has subsided. Note, this doesn't say dropping interest rates, merely pausing rate hikes. Inflation is around 7.7%, and it's speculated that the Fed will continue to increase rates until the inflation rate is halved. The problem is that inflation is not predictable. The Fed can try to use interest rates as brakes to decelerate the rate of inflation, but there are many factors influencing inflation, and most of them are quite outside of the Fed's control. So it's difficult to say with any measure of certainty when inflation rates will subside, when rate hikes will stop, and when the interest rates will go down. Also, because we're coming off of record low mortgage rates, the current rate of 7% seems phenomenally high. But actually, the historical average is 7.76%. The record low rates of the COVID era were never meant to last. So, to conclude, if you're sidelining yourself because you believe that buying right now would mean you're buying at the top, and you think that conditions will be better in a year or two, that might not be the case. The Orlando area has a strong track record for population growth. Builders are scaling back their operations, and interest rates, while higher right now, are still historically below average. These factors suggest that while other areas of the U.S. might be volatile, Orlando is poised for long-term stability.